Great. Good morning. My name is Mike Kaminsky, and I'm a partner at Baker Tilly and the National Real Estate Practice Leader. Welcome to our webinar, State of the Commercial Real Estate Market. I think we're going to have a great attendance today, which is outstanding because Brent has promised me that himself and the panelists have all the answers on where the real estate market is headed in the foreseeable future. In all seriousness, it seems like the market is changing daily, and it'll be great to hear the perspectives of those on the call. We will save time for questions. Please use the chat box. We would prefer that you put your name and your contact information in case we don't get to all questions. We can follow up with you directly. I will now turn it over to Brent Mayer, Baker Tilly's Real Estate Valuation Leader, to introduce himself and the panel.
Thanks, Mike, and welcome everyone to our webinar to discuss the state of the commercial real estate market. We're going to look at the current view and then also want to add what our expectation is for the remainder of the year and the near-term outlook. We have an awesome collection of panelists leading our conversation today. And with us is Chris Vogel, who is a principal with Carlisle's U.S. Real Estate Group, where he serves as the portfolio manager for Carlisle Property Investors Fund. We also have Ashley Grigsby, managing director with Transwestern Development Company, where she leads and executes lending and financial placement for projects across various property types and regions. Ashley leads Transwestern's commercial lending relationships as well. And also Stephen Zigray, a senior vice president of corporate finance and strategy at Ashford Inc., a publicly traded asset manager for two hospitality REITs, Ashford Hospitality Trust and Braemar, which operate about 125 assets. And with that, I want to jump into the conversation. The Fed has decelerated their rate increases with their latest meeting, and it has indicated that it is likely to keep the Fed target rate high for at least a couple of years, trying to bring the target inflation down to 2%. Stephen, we'll start with you. What are your thoughts on the state of the economy today? And maybe if you want to add what your expectation is for the balance of the year.
Sure. So the Fed certainly has slowed down a little bit, and we're very closely watching the inflation numbers that the Fed is watching. I think we see the big headline numbers. We've actually made some pretty significant progress. If you look just since June, on an annualized basis, inflation, headline inflation is only about 3.5%. And so we've made some pretty significant progress there. We still have some hurdles, particularly with shelter, and I can talk about that a little bit. But I think the Fed's going to have a tough time wrangling that one. I do think they're going to keep rates high. I think they're going to continue to kind of talk tough. That's part of corralling inflation is expectations of the market, and I think they want everyone to expect that they're going to do anything and everything necessary. What we haven't really had time to see yet is the full impact of that. And as we've got walls of debt maturities, pre-COVID debt, particularly in commercial real estate, where I think you're going to see a lot of those maturities start to come due. You're going to have much higher cost of financing and refinancing those. Right now, you don't see a ton of transaction activity, but because the bid ask is super wide, you've got sellers who say, well, I think it's worth this. In reality, once you're kind of staring down the barrel of that gun on a potential refinancing, I think we will see a little bit of asset repricing. As far as overall risk of a recession, I think the chances of that, at least in 2023, are certainly subsiding. The labor market is still strong, and ultimately, I think a soft landing for whatever it's worth. I don't know how likely a truly soft, nice, easy landing will be. But if the Fed intends to not inflict a ton of harm on the entire economy, I think the likelihood of a recession is pretty low.
Yeah, let's stick with the maturities coming up, because I think, Ashley, turning to you on the debt piece, give us an idea of kind of where the debt markets are with your relationships and kind of what you're seeing.
Yeah, I mean, what I'm seeing right now is we have a lot of relationships with what I would call regional or super regional banks. And those banks seem to be still looking at deals, but much more conservatively, uh, less likely to push the envelope. Most of the lenders are increasing their metrics that they're looking for on a stabilized basis, not trending, looking at rents today, vacancies today, looking at historic vacancy trends, and not really leaning into the wind, so to speak, as we were seeing maybe a year ago. With regard, and that's really more on the construction side. On the refinance side, we've seen a couple of our projects not quite hit stabilization, or as Stephen indicated, maybe there was a sale that was supposed to happen that didn't occur because we had a buyer maybe drop out or something like that. And in those situations, the lenders are still holding to what was set in the documents for any extensions, but we're not seeing our traditional bank lenders really go outside of the box on any refinancings, and so any of our deals, they're pretty low leverage because they're the existing construction loan, and they're not really open to giving any equity back to any of the borrowers right now. They want to
Yeah,
keep themselves in a pretty safe position.
that's consistent with what we're seeing. And Stephen, you mentioned shelter, and just to draw that out, Chris, will turn to you. If you want to give us just kind of a view on the underlying fundamentals of the multifamily and residential space, because it's obviously going to be an important aspect as we move through the year.
Sure, sure. So on the ground, the fundamentals of various forms of rental housing, so things like multifamily, single family rental, age restricted apartments. We've seen rent growth in many cases running double digits for going on 2 years now. We have seen a little bit of slowing of that, particularly in kind of late 2022 into the sort of early part of 2023. But looking at the year-over-year growth, it's been just extremely strong in the face of inflation. One thing we try to sort of figure out is rent growth high because of inflation, or is inflation high because of rent growth? And Stephen had kind of mentioned this in his comments that depending on which flavor of CPI or which inflation index you're looking at, the housing cost can comprise 30 to 40% of that inflation index. And so when you see sort of double digit, type rent growth go into that, that just leads to sort of sustainably high levels of inflation. From a real estate investor standpoint, though, we have seen, values hold up relatively well in various forms of rental housing because you are seeing rent and NOI growth that is generally paced with inflation or paced ahead of inflation, and that provides some level of defense to rising interest rates and cap rates generally.
And Stephen, going back to you on the shelter comment, do you want to just maybe give a view on how that impacts inflation and how it feeds into CPI?
Yeah.
And maybe kind of we're going to have to digest a lot of these increases, right? And then we're sprinkling in mortgages were above 7%. They've subsided, but maybe just get your thoughts on that.
Yeah, sure. So CPI, the way they incorporate inflation, Chris is right. It's about 34% of CPI weighting is shelter. And so if you look at just the January print, which everybody was a little bit surprised by, that was really driven by two things: energy and shelter. Shelter contributed about half of the month-over-month change in the January number. And what they do is they have a survey, and they basically ask homeowners, how much would your house rent for? and then they have market-based metrics for for rent. But 25 of that 34% is the homeowners. That's the owner equivalent rent. And so when you're asking homeowners, well, what would your home rent for? If you just bought your home and you just got a mortgage on it at 7%, you're probably going to respond with something similar to what you're paying for. There was a buy rent decision that went into you buying that home. And so the responses that you start to get on those are going to reflect the higher cost of financing. The other element of, and this really applies to our industry too, even though we're, in lodging, we're about one of that 34% is shelter away from home. But the other impact that the Fed's having is not just on mortgage rates, but it's on the supply side. And as it becomes more expensive to finance new construction, you see home starts down 4.5% last month. I think there's going to be this supply constraint, and particularly in housing, where you've got this demand, you've got a generational demand for, I'm going to finally get out of my parents' basement. And I think the impact that we're going to see on CPI is going to be felt much longer than the Fed would probably like. And the coincidental piece of that is their continued hikes actually exacerbate that problem. And so the only way you can ever see 2.5% inflation numbers with shelter continuing to ramp up is if you see deflation everywhere else. And that ultimately, so much of everyone's paycheck is going to shelter that they can't afford to continue to spend on goods and services. And I don't think that's the definition of a soft landing. I'm hoping that's not what the Fed is trying to accomplish here. And I think ultimately they'll probably back off. But I think realistically, they just have to accept that inflation might run a little bit hotter than 2.5% for a period of time before they need to start being a little bit more accommodative.
Yeah, and I guess I'll open it up and throw this question out there if you're brave enough to take it. But when does the Fed stop raising rates?
It's a good question. In watching what they've done so far, they have done, and Chairman Powell's done a very good job of kind of telegraphing what they want to do and allowing the market to digest it. And we really haven't had any major surprises as far as, the market thinks we're getting 25 basis points, we get 25 basis points. I think, if you look at forward expectations, a week and a half ago, it was that we would have a hike in March and we'd have a hike in May, and that was it. Now there's a little bit of pricing that, maybe there's, one in June or July as well. I think we'll continue to see data. The jobs numbers in January were questionable. There might have been some adjustments in there that may not reflect the true situation. But I do think as more data comes out and it becomes more clear whether we're going to get that third hike or not, it could be May and we're done, or we may get one more.
And then Ashley, coming back to you on just transaction activity, maybe give us a sense of the current situation, and then what's the outlook for the balance of the year in the multifamily space?
Yeah, we have what we have tried to do is push out some of our contracts to give us some time on land acquisitions, really get all of our contracts in place and everything just pushed as far out as possible to give the debt markets some time to come back around, especially for the larger projects. I think we're seeing if you've got a construction loan that you need that is 30 million or less, there are lenders out there for that. But as you start popping over the 30 million, it's going to have to be some sort of participation or syndication. And most of the lenders are not willing to fully underwrite and accept that syndication risk. And so they want to come in knowing they have a partner or bring in their syndication group on the front end. And I think until it opens up to a lot more lenders being available for those larger deals, we're going to try to push things out a little bit that that we haven't already closed or got a commitment in place from lenders. We still have a very robust and active pipeline. You know, we have 32 projects that we're currently working in various stages of construction, but it's just trying to push some of the ones that maybe were originally going to close in first or second quarter to try to push them out to third quarter, and maybe have some discussions with the sellers about the land prices that were negotiated several months ago.
Yeah, it's interesting because I think what we're seeing and hearing in the marketplace, and actually a lot of the brokerage houses came out with their earnings release. Mike and I were in New York not long ago, and I think the view is the back half of the year is going to be very active in terms of transactions, which was consistent with what a lot of the brokerage houses put out this week in terms of their earnings release and what their expectations are for the year. So it'll be interesting to see how things shake out once we have some clarity right around where debt costs are. And as that buyer-seller spread starts to close. So transitioning to industrial, Chris, we'll turn to you again. If you want to just give us a view on what the underlying fundamentals are for your portfolio and kind of what your thoughts are on the industrial market as a whole.
Sure. So industrial has obviously had just an unprecedented run, both in terms of fundamentals and capital markets over the last several years. I mean, just very, very strong tailwinds from the rise and growth of e-commerce, and some of that really at the expense of traditional brick and mortar retail. So we still think that the fundamentals for the industrial sector are very strong. We think that the users out there are going to continue to sort of require a lot of space. There has been a lot of new supply, but absorption has remained very strong. I think we are seeing somewhat of a repricing within the sector. Cap rates, towards the end of 21 into early 22 got pretty well compressed in several markets. So I think we are seeing a little bit of a repricing there, but still just generally very strong fundamentals. We tend to be focused on a couple of subsectors within industrial that maybe aren't as competitive. Things like low density industrial, outdoor storage, that type of industrial product where, we think that the fundamentals are very strong. It's a very key component of the overall logistics network. But you don't see the same sort of buyer pool as you would, the buyers that are competing on the large, modern, bulk industrial warehouse space. So still very constructive on the sector.
Yeah, I think there's a lot of optimism, right? And then as far as the repricing, I think it feels like, and from our view, that the transaction activity was so active and there's so much demand there that people are now on the sidelines. So again, I think there's pent up demand there to deploy capital into the space. And I think it's interesting looking at large private equity firms doing sale leasebacks, which is kind of an alternative, right, to your traditional financing to provide capital to your business. And that space has remained extremely strong, even into Q4 of 22. And then just saw a headline this morning on a portfolio of 42 properties with Oak Street. They just refinanced those at a 5-year interest only, just over 6%. So just some numbers out there for you. Stephen or Ashley, any other thoughts on industrial? So we're going to get the office because We had some questions from the attendees, and I want to get the office, try to save as much time for that as possible. So just transitioning to retail, and looking at retail over the last several years coming out of the pandemic, we've seen a lot of capital coming into retail. So Ashley, maybe just give your view on retail and kind of what your thoughts are for the outlook.
We don't do a lot of retail unless it's a mixed use.
Yeah.
So I would say on the mixed use side, there is a lot of capital that's very interested in mixed use, but I can't really speak to straight retail.
Well, and I think that's exactly right. Retail is traditional retail has had to get creative, right, in terms of how you attract the users to the property, and adding retail to your multifamily or some other use to your retail is certainly something we've seen, and I think we'll continue to see. So I think if we could start with our polling question, Taylor, if you could put that up, we want to ask and see, just as we get into the office conversation here, it'd be interesting to know who has been in or currently is in the office. And we'll just say, maybe in the last week, if you could just respond to that poll. Have you been in the office, or are you in the office just in the last week? So getting into the office discussion, and I think it'll be interesting to get the different views in terms of what you guys are doing in office, out of office, and just making the rounds. What we find is most real estate companies, whether you're a developer, investor, a service provider, a lot of real estate companies are actually high office users. So there's a high return to office amongst the real estate companies, but that's not the case, right, in terms of other office users. So I think I read somewhere the other day we're about half. We've returned to about half of where we were pre-pandemic. So curious to see where our unofficial scientific poll falls out. CoStar reported for 2022, we had our third consecutive year of net absorption, meaning there were more move outs than move ins. So I'll throw the question out there of, any thoughts on office, return to office, and we'll get into kind of the specifics on the market and what has to happen for us to maybe come out on the other end. But thoughts on office, Stephen, Chris, Ashley, any?
I would say what we're seeing, at least in Houston and kind of in Texas, is a flight to quality. So if you are newer office, well, and also obviously we're in the South, and there's a little bit more, a little bit different there, because people do go into work and they get in their cars. I look out the window and see traffic all day long. But we are definitely seeing a flight to quality. And the newer product is leasing here in our markets, and people are. I mean, we're seeing record rental rates in some of the new construction, new deliveries.
Yeah, I would say that's very consistent. I mean, we're obviously in Dallas. I think just about every survey that came out, Dallas was kind of leading the way as far as back to office, and I think we've been pretty much back to normal for 2 years now. But again, we're in real estate. Traffic jams would suggest others are kind of doing the same around here. But it's very much the same thing. The Class A product is very competitive, but it's typically people taking less space in higher quality buildings. And what it's leaving is these huge voids kind of as you move down to the lower quality assets. And unfortunately for Dallas, we've got a lot of those. We built a ton of office buildings in downtown Dallas in the 80s. And occupancy there is going to take a hit. And from our perspective, we're looking at some redevelopment, not lodging specific, but we're looking at some multi-use projects and maybe potentially some office conversions. The problem is with financing markets the way they are right now, a lot of those projects aren't going to take off and you're going to have a period where I think a lot of those buildings unfortunately sit vacant until there's something forced by the capital markets.
So an interesting thing I read this morning, and it was informative. So the flight to quality is certainly what's happening, and the amount of sublet space available. So companies vacate their space, and they're looking for someone to occupy the space they vacated. So they're subleasing their lease to another tenant. So that space, since the pandemic, that's available, the sublet space available has more than doubled since the beginning of the pandemic. Going into the GFC in 2008, the sublet space increased only 50%. So there's definitely a dynamic shift, right, in terms of what the outlook is for office. And then the next, I don't know if it's the next logical question, but I think a lot of question, and we saw this in our questions coming in through people registering, was what about the office to residential conversions? I have my own view, but would love to get, Chris, I don't know if you have a view on office to residential conversions. We've seen Chicago's got, they're looking to redevelop down on the South Street. We've seen several in New York City. So we'd love to hear your thoughts on office to residential conversions.
Yeah, I think it's one of those things that it gets talked about a lot. I think there will be some of those projects that get launched. I think the opportunity set is going to be pretty limited. So I'm based in Washington, D.C., and we kind of like Dallas, have a lot of older stock of office buildings from the 60s, 70s, 80s. And, one of the things about office buildings around here is you have big city blocks in downtown DC. And so when you think about the footprint of these office buildings, it just, it doesn't really work well for residential conversion if you actually want to have natural light, for example, in your residential unit. So I think it'll be tough. I think there will be some opportunities out there, but it's not really an area where we are active. We generally do not own, at least not in the last sort of 10 years or so, been actively investing in office.
Yeah, and I think that's right. It's got to be the right situation, right? And then part of that formula is obviously natural daylight, access, convenience, but also the cost too, right? Because the situation in Chicago, the landlord, the owner, handed over the keys to the bank. And I think that's really where there has to be some type of price adjustment or write down, really to make that work. And if you have a bunch of write downs on office, and we are going to have this conversion to residential, I think there has to be a broader shift in the office market or real estate market. Stephen, I see you shaking your head. You're either nodding at me like, shut up, or you're agreeing. I don't know.
I agree with all of it. Like I said, we've looked at several of these, and it really boils down to cost. I mean, Chris pointed out a lot of the floor plates just don't work, right? You really can't do a conversion that makes sense. But even the ones where you can, the plumbing in an office building looks nothing like the plumbing in a residential building. There are costs that you would have. We've done some conversions of hotels. That's a little bit more straightforward. But when you look at office, it's just astronomically expensive. And with the supply chain, those issues are getting a little bit better, but construction costs are high. And unless you get some pretty material write downs on kind of your starting ball of wax, I don't think it's going to be hard to make the numbers pencil for those conversions.
Right. I mean, just the plumbing alone, right? Because a hotel, you have plumbing to individual units where everything in an office is in the core, right, and central. And if you've got to distribute those on every single floor, that's cost prohibitive. So just sticking with office for a minute, generally those leases were longer terms. We haven't seen maybe the impact on office that the pandemic had on other sectors in terms of operational right, the margins weren't necessarily impacted until recently. We've seen some headlines in the office space of very high profile real estate firms turning over the keys. And so I guess, what's driving that? Why are we 3 years behind? I have some thoughts, but just throw that out there to see if you guys have any thoughts there. That's, the one example I saw was there was a very large space coming up for renewal, and the tenant did not renew. And so without that tenant, right, that changes the makeup of that prospectus and what that asset looks like. And again, flight to quality, if that tenant's moving to a higher quality, right, like it's going to change the view of what the outlook of that office is. So are we going to see that accelerate in terms of our office owners going to continue to face uphill battles if they can't attract the tenants to their buildings? And in Chicago, I would say we're nowhere near where we were pre-pandemic. We have other issues, but so do other large cities. Manhattan, maybe not in this category, but we have safety issues too, right? So even getting to your building, mass transit isn't back. They're cutting services, and then I noticed, just for me being on the train, it's much more crowded than it was pre-pandemic. Well, that's because they decrease the number of trains, and then also the number of cars on each train. So and then also people tend to go into the office Tuesday, Wednesday, Thursday. Monday and Friday it's wide open, but they're cutting services on that. So got a little sidetracked there, but office is interesting because I think the flight to quality, and I do think we'll see some transactions, whether they're forced or not, will start to come through, and we'll have to digest those before we really have any kind of clarity moving forward.
Brent, I have a small comment on that. It's interesting because I was talking to one of my lenders yesterday who indicated that they've asked him to move into the workout group of his bank. And I said, oh my gosh, I'm not hearing that a ton of the construction loans are really non-performing. Do you have, is your portfolio, what's going on with your portfolio? Is this on the construction side? And what he said was that it was very specific because they're concerned about their office portfolio. And so it's not the multifamily, it's not the industrial. They don't do a lot of retail, so I can't really speak to that. But he said they're concerned with what they see on the horizon, and they want to be staffed up appropriately for workouts on the office side. So I thought that was kind of interesting, in line with what you're saying.
Yeah, that is interesting.
And Brent, you mentioned the lag. We obviously experienced the exact opposite of that. We have one night leases, right? Circumstances change, people terminate their lease on 24 hours notice. And so, April of 2020, we were down 90+%. Offices, typically 5 to 10 year term on the leases. And so you are going to see a lot of that playing out. Circumstances have changed, but you're locked into a lease until a little bit later. And so the staffing up and the focus, I think, for a lot of these workout groups has shifted to an office focus. We already went through the pain of that. So we're happy to be on the other side at this point.
Well, Stephen, just sticking with hospitality, give us I know you had earnings calls today, so kind of give us the view of state of the market and kind of where things are, and then would be interested to hear where group travel is and the direction of that too, because I
think overall the past couple of years have been interesting. We saw a lot of people say, well, I'm not going to travel for work because of COVID, right? But they all traveled on the weekends for leisure, and we saw leisure has absolutely killed it for the last couple of years. And we have, Braemar has almost exclusively leisure resort assets, and they've done incredibly well. They're doing significantly better than they did even in 2019. The urban properties have been slower to recover, and there's a lot of the group business. There's a lot of individual business travel. Group has actually looked phenomenal. Group has been at or near 2019 levels, and group bookings for 2023 are actually ahead of group bookings pre-pandemic. And a lot of that's catch up, I think, on a lot of those group bookings. But it's nice to have that pop. And for us, having seen the recovery already in leisure, will there be some softness in there? Maybe people's credit cards have kind of maxed out at this point. I don't know. But I think we've got this strong tailwind from the recovery of these urban assets. And so as we, even as we look out to, the rest of the year, if we see some softness in the broader economy, we're still in the midst of a recovery on a lot of our portfolio. And so those two, we would hope in that scenario would kind of counteract each other. And we're pretty comfortable where we are right now. We're, as an industry, we're still down about 5% nominal or on a real basis to 2019. But nominally we're up 8%, thanks to the inflation we've been able to push rate. And I think as occupancy kind of continues to recover, and you get that other piece of the RevPAR puzzle to come back, I'm pretty excited about where lodging sits, aside from the difficulties in financing.
I have a quick question, Stephen. Are you seeing group travel shift to different markets? I mean, to Brent's point about, safety issues in places like Chicago, are you seeing that group travel shift to, coastal or whatever?
Yeah, there certainly are winners and losers, and it is a little bit market specific. We have urban markets. San Francisco is still kind of a mess relative to where it's been. Chicago's not great. Portland's been pretty ugly for us. So there are markets that we're frankly I don't know that they'll ever quite recover to pre-pandemic levels, because again circumstances changed in those particular locations as well. Some of the others where you might expect to have some trouble, we've actually been pleasantly surprised with. Philadelphia has actually recovered a little bit quicker than we expected over the past quarter or two. So it is going to be very market specific, but on the whole, just the total amount of activity is certainly outpacing pre-pandemic on the group side.
So just going back to our poll, it looks like 4 out of 5 have been in the office in the past week, which is interesting because I think the measure is we're about so 50% of people are back in the office in some capacity, where here it's 4 out of 5. So that's interesting, and it's consistent with the real estate users tend to be office users more than our non-real estate friends. All right, so we have some questions here. I'm going to throw it out to the group, and if you guys are unsure, that's fine. We'll come back. We'll follow up with everyone individually. But the IRA, the Inflation Reduction Act, and what impact will that have on the real estate market? And if anyone has any views, Chris, I don't know if you have, maybe you're not an IRA follower, but if that's come into play for any of your existing assets.
Not to any noticeable extent, no. Within our portfolio, we really are focused primarily on various forms of rental housing, as well as things like medical office and industrial. So I would say no real notable impact. It does bring up another point. We are constantly really looking and sort of evaluating just the regulatory landscape. And how that may shift over time. In a lot of these sectors, that's really, at least historically, been more at the state level. And so, just try to be mindful of sort of changes in the regulatory landscape at the state and potentially at the federal level. But no real notable impact from the Inflation Reduction Act, I would say.
Ashley or Stephen? Yeah, I agree. I think from our perspective, with other subsidies or awards coming from the government, it generally doesn't make a deal good or worthy. It just makes a good deal better generally, and I suspect that'll be the case. I mean, it is putting a lot of capital into trying to shift the way we use or source our energy. So I do think it'll have that impact, but I'm not sure it really influences how users or how people will transact on real estate. Here's one: will landlords have trouble refinancing their debt? My guess is some will,
Yes.
yeah.
I would say yes. I say, well, it depends on your leverage. It depends on, if you've got office and you've lost a big tenant, versus if you've just got multifamily and, multifamily's gonna lease up. It's just, was it at your original projections? So, I think, yeah, it'll, from my opinion, yes, there's going to be some difficulties.
Yeah, I would echo that. I think it 100% depends on the sector. There's been a wide disparity in availability of capital between sectors. So kind of the two bookends, one being office, the other being apartment. I would say within the apartment sector, there's also the benefit of the agencies. Fannie and Freddie have continued to be active, and they were active during the onset of the pandemic. I mean, that's really kind of their role, is to help support the sort of broader debt capital markets. And they've kind of helped put a floor, even kind of through this volatile time, kind of put a floor on both the pricing and availability of debt capital, particularly for residential sectors.
Yeah, I agree. I think it's going to be a little bit sector specific, but on the whole, the other thing nobody's really talking about is the Fed's also shrinking their balance sheet, and that's sucking a lot of capital out of the markets that's otherwise would otherwise be there. That's going to put upward pressure on spreads, combined with the fact that just higher base rates increase the credit risk. And so spreads are going to stay high there. So even if you're able to refi, your debt balances, it's going to be at a much higher cost, and that's going to have an impact. When you think about that in the context of what's the impact that these rate hikes have on the U.S. economy, we've got about 4 times GDP in total debt, and so if you think about a 1% increase in the cost of that debt, well, that's basically 4% of GDP that's now going to interest service. It's not 1-to-1. They're going to decline because somebody's interest payments typically are their income, right? But as the Fed sucks capital out as well, and a lot of that interest is going back into kind of backfilling what has historically been the Fed's balance sheet, I think we're going to see probably a more profound effect if rates and spreads continue to stay as high as they are.
So want to just remind the audience, if you have any questions, we've got a few rolling in here. Appreciate that. To submit your questions, we'll try to get through them. We have a few more minutes left. But Stephen, I think it was you mentioned industrial cap rates, or maybe it was Chris, I can't recall, how they compressed, and then now you've maybe seen some widening since late 21, early 22. So maybe just revisit the industrial cap rates and kind of where those are.
Sure. And so when I talk about industrial cap rates, I'll be kind of talking about sort of the modern.
Looks like we lost Chris. We'll shift. Okay. Here's a question. If the labor market switches to an employer's market due to the recession, do you think employers will take this opportunity to get people back to the office? Chris, you're back. We lost you for a New York minute.
Oh, sorry about that.
Sorry.
So, when we talk about cap rates for kind of the sort of modern bulk type properties and sort of the primary markets, those cap rates have been north of 6 and call it, 2014, 2015, going back that far. And those had compressed to, in some cases, kind of a high 2 handle, late 2021, early 2022 for kind of the best stuff in the best markets. Now, that figure can be a little bit misleading. Rent growth has been very strong. So within that sort of, call it 3 or even slightly sub 3 cap rate was maybe some element of below market rent or mark to market. We have seen landlords really willingly only sign up tenants with very short-term leases because they were seeing very strong rent growth and didn't want to be kind of encumbered by a longer-term lease with fixed bumps when rates were going up by sort of 10% plus per year. But we have seen, if you kind of normalize for that, cap rates are up. I'd say at least 50 basis points, 75. I think one thing we've seen is, landlords may be willing to do the 5-year, 7-year lease deal instead of a.
So we'll switch. We lost you again, Chris. Sorry about that. So just getting back to the question, I think just to summarize again, the labor market, if it switches from an employee to employer, are we going to see employers trying to get their employees back into the office? And I think we've already seen that, right? I think employers are already trying to try different methods. So I don't know, Ashley, Mike, if you want to jump in here, Stephen, your thoughts on that.
Yeah, no, I agree. I mean, I think culture is so important, and I think employers are focusing on culture and trying to use that as a means to encourage people to get back to the office, as well as to entice the younger folks who are just getting out of college and probably don't even realize what they're missing. I think that employers have to differentiate themselves from a cultural perspective in order to be able to mentor these younger individuals coming into the workforce.
And your office space is one of those tools, right, to separate yourself. And
which again goes to the quality, the flight to quality,
Yeah.
The different things you're doing when you're building these spaces. I mean, they're real pimped out now, and because you're trying to attract those employers, which then subsequently brings in the employees.
Yeah. And then there's a comment here, loan defaults that we discussed a little bit ago. Are those going to be concentrated to the bigger cities? And I don't know if that's the case, because again, it's going to come down to the quality of your asset, and then the credit worthiness of your tenant, and the remaining term on your leases. So I don't think this is going to be isolated. I think we're going to see workouts in across the spectrum. So Chris, coming back to you on, and actually this was asked of me a couple of weeks ago on a podcast, rent control. So rent control mandated by either municipality, county, state. We've heard it at the federal level. Do you think rent control is something that's going to gain traction and we'll have to deal with it more? Or what are your thoughts on rent control?
Yeah, no, it's something that we track and we monitor. The couple points I would make on that is, when you look at areas where there is rent control, one of the impacts of that has been really a crimp on new supply, right? So it's hard to deliver new supply in an area where rent control sort of limits your rents or potential value of the building. And so we think there's still a shortage of housing in this country. We put that number at around 1.9 million units in terms of overall shortage of housing. We think the shortage could be even more pronounced when thinking about demographic trends, the aging of certain age cohorts, and a mismatch between the housing that is there and what is desired by tenants as they sort of age and preferences change. It could be even more pronounced. So really the solution is just to build more housing. We don't think that rent control is an effective means to accomplish that.
Stephen or Ashley, any thoughts? Here's one. What particular commercial type or types are in growth, if any? And I would say, Chris, you touched on it, industrial, infill industrial, right? Just as we kind of try to complete that last mile delivery, outdoor storage being one of them. And then, big box industrial warehousing, right? I don't know, any other views?
Yeah, so some other areas that we're active and still seeing growth. Self-storage is one of those areas. It does benefit, like Stephen mentioned, hotels leasing on one night leases. Self-storage is 1 month leases, and so you tend to have a pretty good real-time indicator of activity there, and it remains to be strong in an inflationary environment. The ability to reset rents to market more frequently on those monthly leases has been, I'd say, valuable. And then rental housing. There's a metric that we track, which is the average cost to rent versus own the same kind of median single-family home. And right now, that gap is at a historical wide level in favor of renting. It's about $1,000 a month benefit when thinking about what home prices have done over the last few years, where interest rates are today, and just the overall sort of cost of maintaining that home. It's about $1,000 a month cheaper to rent that same kind of median single-family home. And so we think that sort of supports continued growth and tailwinds for rent and NOI growth within, say, the single-family rental sector.
I would also add healthcare. I think we're seeing, again, that's going to be geographically specific, but we are seeing leasing in the healthcare industry very strong, as well as, development. But again, it's a flight to quality, which you're just seeing everywhere. But healthcare, I would add, medical office and life science.
Yeah, I think, lodging certainly off of a reduced baseline with COVID, we're seeing great year-over-year growth. A lot of that's recovery, but I do think there's, given the supply constraints we're probably going to see across all forms of commercial real estate over the next couple of years, I think there's potential for probably just about everything but office, unfortunately. But I think if you look around, you either have exposure to the ability to increase pricing, or you've got some real tailwinds just as far as demand growth.
Awesome. Well, any other closing comments before we wrap up and give people a few minutes of their day back? So want to thank our panelists, Stephen, Ashley, Chris. Really appreciate your time. Great insights. I'd like to take a minute to thank my team for all their hard work in pulling together our quarterly report while meeting all our client responsibilities. So shout out to Kevin Seacrest, Nick Palkovic, Mike Natowski, and the rest of our team. Also call out the marketing team for all your assistance and help. All of you are mission critical to getting the report formed and distributed, so thank you all. Thanks to Mike Kaminsky. And remember to download our most recent commercial real estate market update. It's on our website, bakertilly.com. Thanks to everyone for attending. We look forward to connecting with you all soon. Take care.